Welcome to Vicariously Podcast. Thank you for joining us. I'm not sure if this is your first time or I don't know what episode we're on. Anyways, thank you very much for stopping in. Today's guest is old school. I love this guy. Today's guest is Sherman Townsend. Sherman lives right near my parents, right on the water. Has a gorgeous house, and yes, that's one of several houses that Sherman owns. And the reason I bring Sherman on is because Sherman is, like I said, he's old school, but he has gone down the road of being in wealth management, which I think is a really interesting field, because if we look at what's happened over the past 10 years, that whole world is completely upside down. Lehman Brothers, when I worked in sports, that used to be one of my best accounts that would spend hundreds and hundreds of thousands of dollars on corporate and client entertaining every year in sports, completely washed up and gone. Anyways, Sherman Townsend has been in this field for, I believe, 40 plus years, and I think that his perspective on when he started and how he got into that line of work to what has made him successful and to where he sits today. Again, I think the mantra of the Vicariously podcast is to clearly to break the mold and do something that you enjoy each and every day, but also if you are to do that, how can you ensure that you will be effective and you will achieve your goals? Super interesting, I think, because it's the first person that we've had on Vicariously Podcast that is referencing when he was enlisted in the Army and talking about what happened in the 70s and working in the 80s and all the way up to current day, which I think is valuable if you give him a shot. So again, Sherman Townsend of Merrill Lynch as a wealth management consultant who started his own firm. Enjoy. Out. All right, we are here with a special guest today. We have known each other for several years, and I think that the stories and the background that's going to come out of this guest is a little different than some of our previous guests, where it's very entrepreneurial focused, maybe whether it's tailored towards social media campaigns or, kind of on the marketing angle, or when we met with the tiny home builders, that's kind of the new wave in home building. Not to give you a label, but we're dealing with someone who's a little bit more traditional, old school, has been in the corporate world for a long time, has been very successful, and we are with Mr. Sherman Townsend. Hello.
Good morning.
So, to give a quick background as far as your title or the field that you have been in, you work with Merrill Lynch currently. Is that right?
That is correct.
And is it your own firm that you manage?
No, actually, Merrill Lynch, of course, is a large firm now owned by Bank of America since about 2009 or something like that. And but I've been in the industry since 1971. Started out with a small regional firm based in Delaware, and we were acquired in 1975 by Dean Witter, which was a West Coast firm at the time.
I've heard of him.
Yep. And they wanted to get to the East Coast, so they ended up buying our entire Delaware-based firm, which brought them to the East Coast. We had at that time 5 offices in Florida, two in Maryland, 2 in Delaware, Philadelphia, Boston, New York, and 1 in London. So that brought Dean Witter to the East Coast, and they were acquired later by Sears, and things began to change, at least from our perspective. Mm-hmm. And they were currently building a new mall in Dover, Delaware, where I was based, and they decided that it would be a great idea to have a wealth management brokerage advisors in the local mall in a Sears store. Mm-hmm. So the inside joke was socks and stocks. So those of us that looked at it from the professional side, didn't particularly care for that, so we convinced them not to do that to us. But as we progressed forward in the early 80s, personal computers were really starting to catch on, and we wanted to get more computerized and things like that. So we were struggling with the firm to grasp that concept. So 10 of us actually left en masse together and formed a new office with Merrill Lynch in Dover, Delaware, and that was in 1983. So my total, I guess I've been at this about 45 years.
45 years. That is that's quite a tenure. I would guess that you know what the hell you're doing.
Well, the interesting thing, what makes it so exciting, I guess, is that there's never a day goes by that I don't learn something else.
Absolutely.
Because
it's a very valuable lesson right there in any field.
Things change constantly in the marketplace, and certainly the changes that I've seen in the corporate world are significant. I could probably sit here and list 30 companies that you would know the name of, and they don't exist anymore. So a lot of different mergers and things, and that's continuing to happen throughout the industry. But it's been an interesting thing. I just enjoy the excitement. I got interested in it, really. I got interested in buying in stocks and things and doing a little bit of investing, actually, when I was in college. So that sort of got me turned on to that industry.
You went to college at Wake Forest, is that right?
I did. I was looking for a school that had a law school. And coming from Delaware, we didn't have a law school. So I was looking for universities that had law schools. And Wake Forest had just recently moved at that point in 1962, to Winston-Salem, North Carolina. And they had a law school. So I chose to go to school there, which I did do, and went to undergrad there. And did, in fact, go to law school there for 1 year. But back in that era, we had the draft. Vietnam was in full force. So in 1967, deferments were only being given for students in graduate schools in either seminary or in medical school. So I was drafted out of law school into the military, and I served for 3 years.
Wow.
With the U.S. Army. I went to OCS because I wanted to be an officer. So OCS down in Fort Benning, Georgia.
What does OCS stand for?
Officer Candidate School. So you went for 10 months if you had a college degree. Now you could, most guys back then, pretty much all of us knew we were facing the military. So we had what we called ROTC, Reserve Officer Training, at most of the universities. It was mandatory for 2 years, and then the last 2 years were voluntary. But if you took the last 2 years, then you went into the military as an officer right after college. But knowing after my second year there was a probability of going to law school, then I chose not to do the second years because that meant I would have to go in the military. So my little plan didn't work so well because I ended up going in anyway. But I have no regrets about it. My military career was excellent.
You were a lieutenant, correct?
I was a lieutenant, exactly. Second lieutenant and then first lieutenant. So, but I was trained in infantry. I then went back to Fort Knox and trained in armor. And as luck would have it for me, the Russians were building up to invade Czechoslovakia. So I was deployed over to West Germany about 10 days before the Russians invaded Czechoslovakia.
Wow.
And put in a captain's slot as a second lieutenant, as a company commander, because we had very few officers at that time in Europe who actually had been trained in tanks. So a lot of the officers there that outranked me had come, they were helicopter pilots and things, but the Army had to do something with them, so they said, we'll send them to Germany, and nothing's going on over there. So, but anyway, So did you get to drive tanks? Oh, absolutely. Oh, no. Well, I wasn't the driver. I was the tank commander, of course. But I certainly did drive some, just fooling around with them, But when we were actually maneuvering, you have a tank commander, you have a loader, and you have a driver. But the Russian invasion of Czechoslovakia lasted, they call it the Prague Spring. And you can Google Prague Spring in 1968 and it'll tell you all about it. But the Russians didn't want to cross the border into West Germany. So we really had no combat contact with them. But it was a pretty tense time,
I bet,
over there at the time because no one really knew. A lot of Czechoslovakians attempted to get out of the country, but all along the border they had landmines and things, and some made it and some didn't. So it was
They knew their risk as well.
Yeah, it was a pretty tough time.
Yeah,
so. But and then I ended up being transferred down to headquarters and worked for Colonel Allen in the 2nd Armored Cav as his assistant adjutant. So,
which was where?
in Nuremberg.
Wow.
And I was able to bring my wife over after a few months.
Really?
So, yeah. So
wife. So you're, at this point, you're what, 21?
Well, let's see. I was 24.
Okay.
24. I finished college at 22, a year of law school, 23, a year of OCS, 24. So I was, in that 24, 25 range. My wife and I, as many of us did back in the 60s, you found your mate when you were in college, and we both graduated from college and were married within 3 weeks, which we had planned all along.
Pretty standard.
Yeah, and now, if it just doesn't usually happen that way.
Yeah, you're talking to a single 36-year-old right now.
Yeah, I mean, my son didn't get married until he was well into his late 30s, so.
All right, good, thanks. And my just a side note, you obviously know my brother Curtis. He and I only know this number because I had shirts made up for their wedding, but him and his now wife dated for 9 years, 6 months, and 28 days before they got married.
Wow.
So they beat your 3 weeks by a fair amount.
Well, we actually met in high school. We were about 30 miles apart, different schools, but we went to a speed reading course at the University of Delaware, between our junior and senior year of high school, and that's where we met. So we sort of dated a little bit in high school, and then I went off to North Carolina. She went to the University of Delaware, and we kept this little fire going for all 4 years of college, and we got married right after. So.
And that was, that's not easy. That's back when you had to do snail mail and maybe even the pigeon couriers.
Oh, yeah. No. We, you collected quarters because you fed them into the pay machine or into the payphone, which I don't even know where you'd find one now. But, and I didn't have a car my first year in school. And, but back in the 60s, believe it or not, you could put a coat and tie on and have your suitcase with your school on it. Go out on what was the beginning of the interstate system at that time and put your thumb out, and within 5 cars, you'd have a ride, So hitchhiking from North Carolina to Delaware was kind of a no big deal.
Really?
No.
Well, to come full circle, I lived in Delaware for 4 or 5 years, and it's funny that you bring it up because I was dating someone down in North Carolina, and I want to say that it was a tough long distance relationship, and that it did put a strain on us because I'm living in Delaware, and after work on a Friday, you're getting in the car, the Prius, which had great gas mileage, but still took every bit of 7-8 hours to get down there. And so, the irony of your story versus mine, I'm bitching about getting in my car immediately after work and driving down there, and you're hitchhiking and probably taking quite some time to work your way down there.
Yeah, it was easier to get home than it was to get back for some reason. I don't know why that was, but
well, it's something that I hear, and so I'm guessing that most listeners to this, I have no idea, but are not that familiar with Delaware. And the one thing, especially for me living out on the West Coast, the one thing that I hear all the time is people out there have no idea anything about Delaware. They assume that Delaware sucks. They assume that I had the misfortune of living in Delaware, and if someone does know Delaware, has been in Delaware, 9 times out of 10, they mention that they were just passing through Delaware. Right. They didn't stay.
Exactly. Well, Delaware is the first state to sign into the Union. It's 100 miles long, north to south, and 30 miles wide at the widest part. There are 3 counties, and it is unique in many ways. And people that, quote, pass through it is because Interstate 95 goes through that 10 miles of Delaware. So somebody says, I've ever been through Delaware. Yeah, all 10 miles of it, But
if they were on Route 1 and they went from tip to tip, we're still only talking about 2.5 hours at most.
Well, I live in Dover.
Yeah.
And I'm in the center of the state. So I can be anywhere in the state in 1 hour.
I 100% agree. And this is a nice little plug for Delaware out there, is that it is a gorgeous area of the country. I had a blast. I loved my tenure here and I have no qualms with it. So one of the things you shared with me is your family background is deep rooted in Delaware, 300 years.
My family has been the Townsend family has been in Delaware for over 300 years. So we have a lot of roots there. And because it's a small state, you tend to know a lot of people. And that clearly has been, I think, probably the real key to my success in my business was the ability to network. In our business, probably most advisors built their business by cold calling. I've never made a cold call in my entire life.
Oh, that's a beautiful thing.
It's either a referral from someone else, which is the great way to build your business, but I just had the ability to know so many people and just call them up and start talking to them. And, once you gain their confidence and their trust and you gain that account, then you say to them, well, do you have any friends that I should meet? That kind of thing, So it's just this slow, one client at a time. But it took about 10 years for me to really build my business to the point where it was gainful. I mean, but like anything else, you have to start out very slowly and be patient. And I think the key thing is I built my business strictly around always doing what was right for the client. And ironically enough, I've probably spent as much time in my 45 years talking one of my clients out of some crazy idea that he or she has, rather than trying to talk them into something that they should be investing in. So because now, particularly now, even in the last 15 years with all the social media and everything else, and the worst time for all that was in the late 90s when we had the beginning of the technology boom. I would have people call me up and say, Sherman, I want to buy 1,000 shares of PQZY. And I would say, what is PQZY? I don't know. That's the symbol for the stock. Well, what do they do? Well, I don't know. Well, where did you get the recommendation? Oh, I got it from my postman. He was telling me that he'd bought some and it was $3 and now it's $6 and it's going to $20, so I want to buy some, but that was just outrageous, and then we had the .com beginning of everything. And I think in 98, 99, somewhere there, I think there were over 2,000 companies that went public with .com on their name. Very few of those are left, as you know. So, and we had the tech bubble in 2000, so all that collapsed. So those people who were driving trucks across country and quitting their jobs so they could just trade stocks. I mean, it was outrageous what was really happening. People would say, well, I can make more money trading stocks than I can working. So we all know that has all changed.
Yeah. So when you got into this business, what was the transition from being into the military to then picking your field?
Question. When I came out of the military, I knew I wanted to get into the investment advisory business. So I went into the local firm, and I knew some people there, and applied for a job. And they said to me, we'd like to hire you. We know you know a lot of people, but you have absolutely no business experience whatsoever. So why don't you go get some business experience somewhere and come back and see us? So that's exactly what I did that first year. I was able to land a job with a company called International Latex, and they were building the space suits and things like that. They also had the Playtex division, which was primarily girdle and bra and things like that, family products, rubber gloves, and they were based in Dover. So I got a job with them in customer service and credit. Worked there for 1 year, and basically after that year, went back to the firm and said, "Okay, I have a year's experience. I've handed in my resignation, so now you have to hire me." So they did. They gave me a shot. But it's interesting, when they hired me, I came from a farm background. My father was a fairly large grain dealer, dealing in corn and soybeans. So I knew that industry quite well. So they really hired me to be a commodities broker, dealing with hedging grains and things like that. So I started out doing that for a couple of years, and decided that that was extremely intense. You literally, when that market's open, you can't leave your desk. You got to watch everything every minute. And it's very stressful. So I began to do more and more over in the overall investment. But I did commodities for about 10 years. And then I decided, when I switched over to Merrill Lynch, I decided to leave that part of my life behind me because it was just too stressful. So shifted over into really focusing on helping people with their retirement plans. And I tell people, if you've been my client for 30 years, I've educated your children, helped you do that. I've created a retirement plan for you. and you have no debt. So that's always my goal and always has been. So
I'll take that. I'll sign
just
up
go
for
about
that.
it very methodically, just, one day at a time, and we tend not to want clients to buy anything unless they have the cash to pay for it. I know that's old school, but a lot of people have gotten themselves in serious trouble with leverage.
Yeah.
And that's really what occurred with the debacle with the mortgage situation. People were buying houses way over what they had the ability to pay for.
I could have used you about 10 years ago.
Well, it's interesting. They all want to blame this mortgage thing on all the banks. But the reality is that they passed, actually, I think it was in 1998, they wanted to have more and more people in our country to have affordable housing, be able to afford a mortgage. So what the government actually said, we've created a couple institutions here, Fannie and Freddie, and we'll buy the mortgages. So they just opened the gates. So the banks delivered, and people were getting mortgages that were way over their ability to pay. But the reality is what that whole thing did, it took a $200,000 house, and within a very short time, it made it a $400,000 house, and it's still only worth $200,000. That's the problem. So, and all of a sudden, it collapsed. So this $400,000 mortgage on this house, it's a $200,000 house. So they're all underwater, and there's still people out there underwater, even now.
So, random, and this is a lot for me. Not that I'm in this situation now, but I hear it all the time, especially out living in California, is that the American dream it's different for everyone, obviously, but in general, and probably the masses feel that home ownership is just something that they want to check the box. They want to provide for their family, or they want it to show a sense of accomplishment. Who knows? Or they're just they feel like they're tired of throwing away rent. I have no idea what every person's reason is, but the American dream essentially is, one of them is to own a home. However, there are other means, or there are other methods of living within your means to, like I mentioned earlier, to go into a tiny house. Or if you don't know where you're going to live or where you're going to work, and you don't have that true job security, then by all means, just continue to rent and try and keep the rent price down, et cetera. So from someone who's been a wealth advisor and dealt with people of all magnitudes of different incomes, where would you kind of slot the home ownership piece into everything?
I think there are two factors. I think one is location. And my thinking is that it would be very different in Delaware than it would be in California. Very different markets. The second piece of that is I would never advise anyone to get into home ownership unless they had at least a 5-year minimum objective of being there. It takes time to build it, to build up the equity. And so I think that you have to think that through. And today, in my era, if you got a decent job with a corporation, you were there for your lifetime. Mm-hmm. And most people in my age bracket, the old saying was that you're allowed 3 different employers in your career. And now if a young person comes in to interview with us, and let's say they're 35 years old and they've had one job since they got out of college, we would probably say, oh, this person doesn't have a lot of drive. So it's really flip-flopped.
I agree. I was on my second page of my resume by probably 28.
Exactly. So, but there's also an extreme to that as well, and I think you kind of have to look at, if someone comes in and I look at a resume and I see they've had, they're 35 years old and they've had 6 jobs. I want to say, what are those jobs? Mm-hmm. Was there clear thinking in their progression of where they were? Did they stay with the same industry? If they changed, why did they change? And as you interview them, you say, well, I did this for 5 years, but I found this to be not what I really wanted to do. But I think the key, switching gears a little bit here, to success in anything you do, it's about the passion. It's about enjoying that job, feeling you can be effective, feeling you can make a difference. And really, if you get up in the morning and say, oh, I got to go to work, you need to change jobs. But if you get up in the morning and say, golly day, what's going to be on my plate today? This is going to be, or I'm working on this project and I can't wait to get back to it. So it's all, I think most people will be very good at what they do if they like what they do. But if they don't like what they do, they're not going to be good at it, and they're just not going to progress in that industry.
That is very well said. I 100% agree with that, and that's why you and I are sitting here with microphones. I'm going to go back to one thing that you started to talk about earlier. But for me personally, growing up in sports, playing sports, watching sports, just being inundated and having that passion for sports is why I got into sports. Once I was in it, invested, and had logged 10, 12, 13 years, whatever it got to, it for me, it got old, and it was like the nostalgia wore off, and it just wasn't nearly as glamorous. And I don't even want to say pigeonholed, because I wasn't pigeonholed with the job or the location. It was more about the overall satisfaction at the end of the day. And so for you, dealing with someone's wealth and management, being able to have a friend that you're working with that you helped put their kids through college, or help them get out of debt, or help them set a lifelong timeline, I think that that's very rewarding. And I see it. I've never been into investments. I've never been into wealth management, but me sitting here right now, I find that very interesting. And I think that that's extremely rewarding. For me, selling sports sponsorships and bringing joy to someone who came out for the game, or their company outing in a suite, or they had floor seats, that's awesome. But it's pretty small on the scale of having that sense of accomplishment. And so that's what got old, was that, 13 years in, sports was awesome, and I had my own benefit, and I love the perks that I got. But at the end of the day, when I was going to work in the morning, I feel like I'm not contributing to society in any meaningful capacity, which, no knock on anyone out there. It's not for everyone, and some people absolutely love it. But for me, that's where I had the disconnect. And so to go back to, you're 25 years old and you decide that you want to be in wealth management, or you want to be in investments. How did you have that sense? Or how did you have that interest, number one? And number two, once you're 10 years in, or as you mentioned, that it took 10 years to really kind of have that foothold on the industry, didn't you have times within that 10 years that you kind of scratched your head and said, this isn't as cool as I thought, let me start looking at other industries?
Well, I certainly had, during that 10-year period, I did have, I can think back of 2 or 3 opportunities that were presented to me by people that knew me, wanting me to come work with them or for them. And I looked at that, a couple different things, but I knew that working for someone else, particularly in a family business, there was a limit. Mm-hmm. And I knew what I was doing. There was no limit. It was going to be whatever I built, whatever I chose to do. And I really enjoyed that challenge. And I guess the 10-year thing for me was, I think it probably took me that long to build the confidence that I needed to effectively break away. I mean, I'll never forget the day I left Dean Witter. You walk out of that firm, and what do you have? You have your pen and your business suit, and you're going to go start all over again. And you pray and hope that those clients that you've serviced are going to transfer and come with you. And there'll be surprises. And we all have them. You say, oh, well, geez, this guy decided he wouldn't come. I'm shocked. But I was very fortunate in that the majority of my clients decided to follow me, and that's where I launched, because leaving and starting over, it was like getting on a bicycle and you're in a race and you got to pedal as hard as you can pedal for the next 12 months. And it was fun. It was tiring, but I had a very supportive spouse, and I had a very supportive group of coworkers. We all did it together. So it was a team. So I think that made a big difference as well. And I think that, again, businesses are every industry is different. But to me, if you can find a group of people that you enjoy being with, share the same values, and you can work as a team, then you build on each other. So I look, even in my business, I have a team. I have a team that works with me, very, very carefully chosen by me. My business partner, whom I've now turned over most of our business to, I'm still supporting her as a consultant, but I hired her when she was 22 years old, right out of school. And I will never forget the manager saying to me, why would you hire this person with zero experience? They know nothing about this business. And my response was, that's wonderful. I have no bad habits to break. So It's all about the chemistry. And I knew that this person certainly had the intelligence, had the drive. She was what I call hungry. You want to hire young employees that are hungry and willing to work. And she was. So she's been with me 36 years now.
Wow.
So I hired her when I made that change to Merrill Lynch. So, and then we now have 4 other people working with us. But we all work as a team, and it builds a lot of synergy, and everybody has their area of responsibility, and it works. So, but some industries, I just think that I even look at my own son, who is an engineer / business guy in the real estate development business, and he's with a team. He kind of found his own team, and he's very successful doing that. Far more successful than he would be being solo. Mm-hmm. So I think that has a lot to know. You can't adapt that strategy to every job, but if you start thinking out of the box a little bit, maybe you can.
I definitely agree with that. And I think the other aspect of that is something that you mentioned in the very beginning, is that you do have to be very careful on who you select. Because if your morals don't align, if your goals don't align, if your just overall cohesiveness with that partner that plays such a integral part in everything that you're doing, if that doesn't align, then it can all fall apart.
Exactly. No, again, it goes back to, I call it chemistry. Mm-hmm. And there's an interesting book called Blink. And I read that book several years ago and had the opportunity to hear the author in person at one of our meetings on one of our trips. And it was like, oh my gosh, this is my biography. And so those of you that are listening out there, it's an easy read. It's a small book, but it's about your ability to sense if something sounds too good to be true. It usually is. So, but I'm quick on trying to assess what's happening here. Can feel that I have a pretty decent feeling on looking at something and saying, this isn't going to work, or I think this is going to work.
Yeah.
So a lot of that is inherent, and I don't know how you train or teach that.
Yeah.
But I have one other person on my team that is very instinctive to the point where when she started working with me, within 6 months, she was finishing my sentences.
Sometimes that's good.
Sometimes that's good. Exactly. Or I would say, hey, Sherman, I already know what you're thinking. I've already taken care of it. So it's a chemistry.
So one of my questions, and this is just going back to anyone who is from Delaware or vested in Delaware, can probably appreciate this. Anyone who's not in Delaware, especially on the West Coast, but I guess the Delmarva Peninsula, which is, Maryland, Pennsylvania, Virginia, DC, Delaware, all of that. There are big businesses like up in Wilmington where they have Fortune 500 companies. There's obviously Baltimore and DC, which have major metropolitan areas. But on the outskirts, especially in Delaware, there are a lot of your traditional mom and pop shops still. There's a lot of blue collar workers. My dad, for example, is a bus driver and used to sell cars. Obviously, he had a business before that. And my mom has been a school teacher for 20-some years. In Delaware, especially where we're at right now, here on the Chesapeake Bay, there are a ton of, like you said, farmers, watermen, and they live a very honest living, but it's tough work. And so when I say watermen, you're going to know a lot better than me, but that's crabbers, that's fishermen, that's oysters, that's just everything to do with being on the water. Now, those folks that earn a very they don't earn their money easily.
Right.
Not saying that you do or I do or anyone does, but they work for every penny. I'm assuming that a good bulk of your clients early on, maybe not so much now, but early on, were those true kind of traditional farmers, watermen, the blue collar workers. Was that a challenge to get them to kind of open up their retirement funds or come to you with? Because I'm guessing that they had pretty limited funds, and they're now talking to you to manage their lifestyle moving forward.
Yeah, that's a very good question. And bear in mind, the environment through the 70s was very different than it is today. The industry is very different. As I said earlier, I built my book/business one client at a time. And the biggest obstacle I had, being in a rural area where we have a lot of farm community and people, as you mentioned, it required educating those people. I would say that 90% of my clients that I gained in the all through the 70s had never bought stock in their life. So you have to start very slowly. And you start out, I taught classes for 10 years in 2 different adult education programs. And what I would do would be to try to keep it very basic, teach them how to read the New York markets in terms of reading the stock pages, the Wall Street Journal. But the fun part of it was at the end of usually those classes are about 10 weeks, 2 nights a week for 10 weeks. But they would understand what stock was, what bonds were, what the difference between preferred stock and common stock, and understanding price earnings ratios, all these things that just kind of people hear it, but they don't really know what it means. Mm-hmm. But I would rent a bus and take all those people to the New York Stock Exchange for the day. And get them right on the floor of the exchange, have them, and so they got to feel part of it, and so the beauty of that was when they came home, when they went to the Rotary Club or to the Lions Club or whatever club they were in, the gentleman, or even if they went to church, they'd say, "Oh man, you aren't going to believe what I did this week. I went to the New York Stock Exchange with Sherman Townsend, you ought to really get into this, so you kind of built it, that way. And then back then in Delaware, we had a utility company called Delmarva Power and Light. Pretty solid investment. Everybody has to have electricity.
Yeah, they've took plenty of my money over the years.
Yeah, the stock was, the stock was $10, $15, $18. Paid about a 7% dividend. So, you can sell that to anybody. Mm-hmm. So you started out and you'd say, well, why don't you just start with 10 shares? It's 10 shares of a $15 stock. I mean, it's a $150 investment. But they've got 8 or 10,000 tucked away in a savings account somewhere, and so they buy that, and all of a sudden it works. And at the end of the first 6 or 8 months, they've gotten 2 dividends, and they go, "Wow, this is really cool." So hey, I got another 5,000 here, that sort of thing. So that's kind of how you did it. Mm-hmm. I don't think you could do that today. Because it's a very different market, very different. Most of your larger firms now have minimums on opening accounts and things like that. So it's a very different world today. So it's much more difficult today, I think, to build a business from scratch in my industry than it was in my early years. So
yeah, that makes sense. But I would say that the underlying theme there is that you bring value to your customers. So obviously it's probably changed from 1975 to 2015. That's 30-year gap, but it's a lot has changed, but the underlying theme is that you bring value to the customers, and you also are very trusted by all of your customers and your partners. So that piece hasn't changed. Maybe the methods that you do has, but that piece hasn't changed.
Yeah. No, it's all about first and foremost building that trust, and then it's about networking. And as I said earlier, I've been very fortunate in that the majority of my larger relationships have come either from someone I've known all my life or from someone who was referred to me by someone else, and it's interesting. If you have a client that is, let's say, worth $2 million, and you ask them if they have any friends and would they be interested in making any referrals, the $2 million client refers you another $2 million client. It's amazing how that happens. Mm-hmm. But if the client is a $500,000 client, then you're going to get another $500,000 client. I mean, it's just they tend to travel in the same circles in many cases, and they surround themselves by friends of equal economic. In many cases, it's no one's. I don't know anyone's ever done any research on this, but it's just kind of interesting. It's an observation that I've had over the years.
I'm going to look into that one. So. From a,
it's like the guy that robbed the bank, and he went before the judge, and the judge said to him, "Luke, did you rob that bank?" He said, "Yes, Your Honor, I did." "Why did you rob the bank?" He said, "Because that's where the money is." So you got to go where the money is.
Well said. Well, that brings me to my next question of if there's someone out there listening that has a couple grand in their savings, or they have $100,000 in their savings and they're trying to figure out what to do. You've seen a lot of change in your time in this business. So, and obviously I know that you can't go into specifics, but generalize kind of two parts. One, what would you recommend for someone, I guess, in my case? So we'll go, 28 to 38, somewhere kind of in that range to moving forward. So that's kind of the first part. And the other part is, and this is probably a much bigger question, but where do you see this stuff going? Because there's a shitload of changes that have happened just in the last couple weeks and couple months. But obviously the trends over the past couple of years are pretty crazy.
Well, there's a lot more government intervention in the rules and regulations, all well intended, but they create obstacles in many cases for the smaller investor. But basically, the smaller investor getting started needs to, in my opinion, get counsel from someone who's done it before or in the business. But as far as the investment side of it, younger people in particular, the first thing that I would recommend is that if you are not participating if you work for a company and they have a retirement plan, by all means participate in that retirement plan. And they will usually have some decent choices for you within that 401k or whatever plan it is. If you're self-employed, then you certainly should be looking at the IRA side of things. If you're employed and earning a fairly high salary, then if that IRA contribution tax deduction is favorable from a tax standpoint, then do the IRA. But if I were certainly below the age of 40, I would be recommending that you take full advantage of the Roth IRA, where you're putting money in after tax, but all those earnings for the next several years will accumulate on a tax-free basis. Mm-hmm. So
I think you have to make under a certain amount.
That is correct. Yeah, there's a limit.
Yeah.
There's a limit on that.
But it's steep. I mean, it's like 110, I believe.
Yeah, I think that might even be up to 140, 150,
okay.
Something like that. But anyway,
so
there is a limit.
The bulk of people should be able to
The bulk of people, yeah. And if people are well above that 100,000 range, then if they're working for a company, then most companies today are going to offer some match for the 401k. So first and foremost, I'd be looking at that. And as you begin to build that retirement nest egg, kids come along, you've got to think about educating them. Some would argue that, by the time I actually heard this yesterday, by the time my kids get to be 18, it'll all be free. I don't think so.
And even if it is, might as well put money in the account and plan for it, because then you can still take it out.
Exactly. And for those of you out there that might be grandparents listening, I encourage you to look at gifting, if you have available funds, to the grandchildren in a 529 program for their higher education. Mm-hmm. So,
and you can build those as soon as that little one pops out. And that can be done by a grandparent, a sibling, basically anyone in the immediate family.
Right. As soon as they get the Social Security number, you can start that plan. Exactly. And grandparents can put in 5 years worth of their legal gift, which is $14,000 a year, all at one time if they want to fund it that much up front. And I've had a few grandparents that have done that. And one of my best friends, when we were real young, I was just getting in the business, and he was a young new dentist. Had come to town, and he had 5 kids, all below the age of, I think, 8. Mm-hmm. So we sat down to do some planning, and I said to him, well, the first thing we got to do is think about educating these kids. So back in those days, we could buy government-guaranteed bonds called TIPS, Treasury Investment Protected Securities. So it was like a zero coupon bond. They paid no interest to you, but you could buy a bond, let's say, in 1975 that was going to mature in 1993, which was 18 years later, when little Johnny is going to be going to school. So you could buy a $10,000 bond for maybe $1,500 or $22,000 or something like that. So it just and so when it matured, so we sat down with a schedule. Okay, Johnny's going to start to school this year, and so there was going to be a period of time there over almost a 15-year period when there was only 1 year that he wasn't paying tuition for somebody. The way his kids were spread out. So you sort of look at that and map it out and do a spreadsheet. So we literally funded his kids' college educations over a period of 2 or 3 years there.
Wow.
And it worked. Now, those were in the days when we were getting much, much higher interest rates. Mm-hmm. So that but it was a guaranteed thing. So you couldn't do that today with interest rates where they are.
But if you have a Roth IRA and you set that up and you do the maximum of $14K when the
No, not a Roth. No.
Oh, okay.
No.
Sorry, the 529. So if you're setting up something like that for a child and you do the max right away, that's then sitting for so let's say you put in 14,000 when the child's 1, 14 more thousand when the child's 2. Do it every year. And again, within these 529 plans, each state has a little bit different supported plan. And it's some of them are what we call age-based. So you allow them to handle the investments. So the younger the child is, the more aggressive they will be because they have more time. So they'll be more in growth issues. The closer that child gets to be 18, we know we're going to need the money. So we get more and more conservative to eliminate the volatility. We don't want the child turning 18. All of a sudden we got to pull out, and the market's way down. Yeah. So the age-based, I think, is for the average person, that's the better way to go. Very cool. And anybody can pitch in for that. So
sure.
Very cool. So where do you see, obviously you still have confidence in the economy and in the market.
Yeah, I do. I mean, when you think about it, what are the alternatives today for people that have money to invest their money? Where do they get the best bang for their dollar? For years, some would argue it was real estate. And it was. I have many, many multimillionaires that have made their money in real estate. And I think in some selected areas, that's still a possibility. But we're just not seeing, since 2008, the significant appreciation in real estate that we witnessed. Of course, the largest advancement we saw was in the early 2000s. But that was driven by mortgage availability. But I think that going forward, real estate, you have to be extremely selective. And real estate, as far as an investment, you have to understand it's not liquid. So you have to be quite careful there. The beauty of the investment side of the world is that, or the stock side of the world, is that you have liquidity. And I still believe, if you believe in this country, and let's hope we all do, we have well over 100 companies in this country now that have paid and raised their dividend every year for the last 10 years. So that's a large group of companies. And we have companies out here that have paid a dividend for more than 50 years, and raised it. Procter & Gamble, companies like that. So the more conservative investor can buy those quality U.S. companies, even quality global companies now. Many, many companies that you and I see operating in our everyday here, we think they're U.S. companies, but they aren't. A lot of them are British, different German companies, that are here doing business in this country. But, certainly technology is going to continue to be, but it's such a fast-moving target. You have to be somewhat lucky in a way to really, catch the right one because, Facebook's here today, it's flying high, but 10 years from now, will it still be here? Who knows? I mean, those kinds of things can move all over the board, But, if we had been lucky enough to hang our hat on Apple, and I had an interesting client that did that. He took one of my investment classes, and this is many years ago, and he was actually on the school board of his local school. And he went to some meeting with the school board, some kind of a national conference or something, and he came home and he called me on the phone and he said, you know anything about a company called Apple? I said, yeah, it's a little computer company. It's kind of getting going, and this guy's kind of started in his garage, and da-da-da-da-da. And he says, well, I want to open an IRA, and I want to put $5,000 in Apple. I said, are you sure you want to put it all in one stock? He said, yeah. He said, I can afford it. He says, that's only $5,000. So
what year is this? This is
I wish I knew. I could have to go back and look at my records.
Early 90s, mid.
Oh, I think pre that.
Yeah, mid 80s ish. Well, in the garage, yeah,
I guess probably late 80s. Probably late 80s.
So anyway, $5,000's a good chunk of change. Still.
Yeah, it was. So his $5,000 investment is now. I looked at it just a couple of days ago, just under $1 million. And yet he's breaking every rule in the book, having a concentrated position in one stock. But if it's, in his mind, it's not $900,000, it's $5,000. So, of course, he's of age now, so he's having to take mandatory distributions from his, because he's over 70.
He's a good client.
And, he's a fascinating, interesting guy. Been very successful in his business and very successful. I mean, this is just one small aspect of his, it's kind of his play account in a way, but he doesn't really play. He just sits there and laughs.
I love that.
So
what's next?
Technology is good. I think going forward, you have to be selective. The other, of course, is healthcare.
Yeah.
Healthcare is healthcare. And the aging boomers is just going to continue. And, there are a lot of things against the pharmacy companies. They're shortening the term for their patents on drugs, and there's a lot, that kind of thing. It takes 7 years to bring a new drug to the market. So there are a lot of obstacles out there for that pharma industry. But I think in time, that's going to change some too, because I think that they're going to have to shorten the time to bring some of these drugs to market and things like that. So, especially
with the money and the resources they have to test and to activate and to get to market so quickly, which years ago, obviously, it was a much more drawn out process.
Right.
So,
So but I think if you do, if the average person just looks around and says, where am I spending my money? What am I buying? Where am I buying it? So we're not buying at Sears anymore.
Yeah.
So
that's gone.
We see what's happening. Amazing. When I was a child living on a farm, everything we bought came from either Sears and Roebuck or a company called Montgomery Ward.
I know Montgomery Ward. I actually have a funny story about that.
They had these huge, 2-inch thick catalogs, and they could buy anything you wanted, and you could order it, and it would,
I remember we were sitting at the ground round in, I guess it was like Overley area. Anyways, my grandmother at the time was going through her purse, and she had all her credit cards out there, and I was young, and she was cleaning out some of the stuff from her purse, and she had a credit card from Montgomery Wards, and she was like, "Wow, they're out of business," and she gave it to me, and no one at the table was paying attention. And then later they saw me with the credit card, and my mom was like, "No, that's live. They're still, it's still around. It's almost on its way out." But you just gave a 9-year-old a legit live credit card, so you're gonna want to take that back.
Right.
That's how I know Montgomery Wards. But
so delivery of product is changing rapidly, and the thing is, things will continue to move at light speed, and I think that we have to be adaptable to that. And as far as a lot of the younger people, the millennials, they have to be somewhat thoughtful, creative in their thinking, and find a niche. I think that going forward, there's going to be so many entrepreneurial opportunities, and the smart entrepreneurial people are going to be very successful. But you have to be creative and thinking out of the box. But find the niche you like, find the niche you enjoy, and go for it. And if that works for 10 years and it's gone, now you have to shift to something else. But I know several people over the years that have started 4, 5, 6 different companies over the last 20 years. And every one of them have been successful. But whatever that particular product was that they were making, it's not used anymore, because something better's come out, So you just have to be able to adapt, to the surroundings. So
that is very good wisdom. It's very good insight. I think just to kind of wrap things up, first of all, I really appreciate you giving us kind of the overview and a glimpse into your life story here from a career standpoint and from how you got into it. But
I've been a very fortunate, very, the question I want you to answer is, do you make your luck or does it just fall? You never quite, I've never been able to answer that question. That's the unknown that I think all of us have. Are you successful because you just happen to be at the right place at the right time, or do you create your luck?
That's a very good posed question, and I would have to say, for me personally, it all comes down to attitude. And I think it really shines through with you is that you have been definitive on what you're getting into, which some people may see that as, hey man, I can't relate. Like I don't know what I want to get into. I'm not that definitive on, I want to get into, wealth management, which is fine. That's irrelevant. The bigger piece to it is that you got into it and you had a game plan of, I'm going to be a straight shooter with everyone. I'm going to take care of anyone and everyone that I come in contact with. I'm going to deliver the best product that I can, and I'm getting into this long term to make relationships and to take care of people. So just that mentality of I'm diving into this and there is no backup plan and I am going to succeed at this, not for your own financial stature, but for the clients and the clientele that you work with. I think that is massive message. The second part is to pose it back on me is, I've always thought that everything happens for a reason, but I think that you can easily kind of have the blinders on and say, oh, woe is me on this situation, or, oh, I just made a wrong decision here, or my boss sucks, or the company isn't what I expected. You can have that mentality, or you can go into it and you can say, well, I tried it. It didn't turn out to be the best situation for me, but oh, by the way, I met these 7 people while doing it, and now I know more about myself and I know more about what I want to channel into. Right. And so for me personally, and just from listening to your story and kind of knowing your background, is I think that you make your luck. I think that if you have the right attitude, if you have the right kind of outlook on life, and you take that positive approach, then you're going to be successful. And it may not be the stereotypical success. And so because I have a positive outlook and my attitude is what it is, I say I'm very successful. Yet someone on the outside is looking at my bank account and the fact that I don't have a traditional job and et cetera, may not see that.
But success is not always about the money.
Exactly.
I mean, we have millions of people out here who are really contributing wonderful things to our society, and it's not about the money, So there's very different mentalities about your definition of success,
Agreed.
And, I know many, many very, very successful school teachers, the most underpaid group of people in the country, unfortunately. Very successful, but they're certainly not doing it for the money. I mean, they could be doing something else completely different, but they've chosen that profession and they enjoy doing it. And I applaud that particular group, particularly the public school teachers. Agreed.
And I would say, in kind of closing here, is that it really is what you make of it. And I think that one of the biggest pieces, the biggest takeaways, and a number of other people have said it, but it really does come down to the passion. And it's funny that going back to however long this podcast has been, is that was one of the first things that you brought up, is that if you get up each day and you are happy with the position you're in, then keep going with it. If you're not, make a change.
Right. And then when you make a decision, you head off with it. And if you detect at any point that it was a mistake, admit it, change it, move on. So many people get locked into something and say, oh, I've made this decision, I have to keep going, even though it's, so that's the hardest thing. I think a lot of business people in particular make a mistake and they don't want to admit, like, oops, this is not working. But in my business, when you make a mistake, it's costly instantly. So you have to recognize that, and you've got to cut your losses quickly. Mm-hmm. So you just got to get out and say, whoops, that was a mistake, So we make them, and we learn by our mistakes. I mean, that's the key. I mean, if you really never make a mistake, you're really not going to learn a whole lot.
Everybody makes mistakes. You have to. And if you haven't been making mistakes, then it's probably your perspective that you haven't been making mistakes.
Yeah, I'm a woodworker by hobby. And sometimes my wife will come over to my workshop and she'll say, well, what are you making? Oh, I'm making a table. Oh, well, where's your plan? Well, I don't really have a plan. It's in my head. Well, why don't you have a plan? I said, well, if I have a plan and I make a mistake, I have to recut that board. But in my head, I made the mistake, so now this table is going to be 29 inches high instead of 30. This is going to be a little shorter, that's all.
It may turn into a coffee table.
Yeah.
Very cool. Well, I appreciate your time today, Sherman. It was a pleasure. Very, very good insight and wisdom, and thank you very much.
And Luke, thank you, and best of luck to you and your project.